Good morning, everyone. How are y'all doing? Good. Good to see all of you today. And thank you so much for having me. So I can see that I'm the only speaker for bonds today. And I'm just wondering in the crowd, how many of you invested in bonds or have experience investing in bonds? Okay, I would say it's not a majority. I think more people are less familiar with bonds compared to equity or stocks. So let me just start with a little lesson about bonds, right? A very quick one. When you invest in a bond, basically you are a lender. You are acting like a bank, right? And you are lending money to bond issuers who are generally either governments or corporates or banks. So if you lend your money to a government, you expect to be paid an interest rate, right? Like a loan. And the safest is to lend your money to a government because the chance of a default is lower compared to, let's say, you lend your money to a company. But again, there's definitely different risk when you lend money to different government. For example, if you lend money to the Malaysian government or the US government, the risk is different from if you lend your money to Argentina, which has shown many times of default history. So what I want to highlight here is not all bonds are the same. The other thing is corporate bonds as well. You might be hearing terms like investment grade or high yield or what we call junk bonds. So the difference is that bonds, because to help investors understand the risk, we have these companies called rating agencies that rate how safe or how risky are these corporates or banks. So investment grade bonds refers to bonds that are high quality or rated BBB and above. So they are much more stronger in terms of their credit profile. And high yield bonds are basically companies that could be weaker in terms of their, having higher borrowing, higher leverage, or weaker cash flow. But of course, if you are a bond investor, you want to demand a higher interest rates when you lend to high yield, issuers. So that's a very quick history on bonds. Let me just move on to show you that, why do people invest in bonds? And so I have been in the bond market for over 23 years, 24 years now. And I've been with AHAM for about 20 years. So I have been in the market for quite a number of years. And over the years, what we've been telling investors and what is the objective of investing in bonds, there are really three things. And we have a lot of clients who are pension companies or insurance companies, and they generally keep about 60-70% of their investment into bonds. There are three reasons why they like to do that. Number one, because you are a lender, you are paid a fixed interest rates, and if there is no default, you will always get back your capital. Is that right? So for pension funds and insurance companies, what they want is the regular income. So bonds give you that regular income. And secondly, bonds are generally less volatile compared to stocks, right? So in the history of the last 100, 150 years, bonds generally give you a lower volatility and generally a positive returns. Because unless you have a very sharp interest rate rise or very, very bad crisis where there's a lot of defaults, you generally will get back your capital. So they will provide you that stability of your returns. And lastly, because bonds behave differently from equity market, we tend to have, you can actually make sure that when you have a portfolio of both stocks and bonds, you can balance out the risk and reduce the overall risk of your portfolio. So here I have a 10-year track record of different segments of the bond market to show you how bonds have performed. So here what I have shown you is, from 2013 to 2023. And from the top to the bottom are basically the different segment of bond market that have done the best and to the worst performing segment. So remember when I first started the session, I said not all bonds are the same. So it depends what kind of bonds do you invest in. You could get different returns. And if you look at this chart, I hope you can see, Generally, bonds give you positive returns year on year. There are certain periods where in 2018, for example, some of the segment give you some negative returns. But even if you suffer losses from bonds, usually it's less painful. You might lose 2%, 3%, but it's not as significant as stock market. However, take a look at 2022. And for those who have put up your hands, who have exposure to bonds, and including me, who has been in the market for over 23 years, last year was the worst year we have seen in terms of how bonds have performed globally. And when I say the worst year we have seen, I'm talking about even going back as far as 100 years. We have not seen how bonds have given negative returns of more than double digits across almost all segments of the bond market. So it was a horrendous and very tough time for bond investors last year. And, you know, I think the earlier speaker, and I'm sure the rest of the speakers today will be also talking about inflation, this word, inflation. So I just want to share, you know, why is it that the bond market has such a bad year last year, and what is the outlook going forward? Are we going to expect bond market to continue to see negative returns, or are we going to see a turnaround? So before I start, you know, why is bond so sensitive to interest rates and inflation? Why is inflation the enemy of bond market, right? So if you are a lender and you have given a loan, or, you know, you bought a bond for, let's say you buy a Malaysian government bonds and you bought it at 3%, okay? But then Bank Negara decided to increase interest rates to 5%, let's say. And basically what happened is a new investors who buy the new bond now can earn 5%, but you bought your bond at 3%. So is your bond worth more or less today? It should be worth less, right? Because now you are only getting paid 3%, whereas the new guy is getting paid 5%. So the market value of your bond will go down. So this is what happens when interest rate rise, and the impact on the existing bonds will be negative. But is it good news for those who are coming in to buy at 5%? Yes, right? Because they are getting paid a much higher interest rates. So that's why there is this negative correlation between interest rates and bond price. And in 2022, we have seen that the US Federal Reserve, the US Central Bank, had the most aggressive interest rate hikes in a very short period of time, where over 10 consecutive meetings, they hiked over 500%, or 500 basis points, or over 5%. And that is a tremendous interest rate hikes, and it caused all sorts of correction in the marketplace, whether in equity market or the bond market. So last year we saw that there was nowhere to hide. All asset classes were hit badly. So just go rewind a little bit. Why did the Federal Reserve have to hike so aggressively? Why was inflation so high? And is it going to go under control, or are we going to see inflation going higher going forward? Yeah. So to answer that question, we know back in 2020, when we were all hit by the COVID pandemic, every central banks and government was so concerned that are we going to a Great Depression, right? I mean, never in our lives that the whole world shut down. So because of that very dramatic pandemic, central banks and government, they work together and pump in a tremendous amount of money into their different countries, right? Globally, in 2020, more than 10 trillion was spent because of the pandemic, just from the fiscal, means from the government, excluding the interest rate cuts that we have seen. So what I want to say is that a lot of money went to consumers' pockets, businesses, because we had to prevent a meltdown. And hence, in 2020, despite the pandemic, we had the shortest recession in history, 3 months of recession, and we had a strong recovery of bond and equity markets. Because so much money went into the system, and investors, you know, when consumers feel rich, what do? They start spending. So this is especially so in the developed markets, like in the West. In the US, UK, Europe, Australia, they have spent the most. In Asia, I suppose because a lot of our Asian economy is smaller, we don't have as much firepower or bullets to give out to our rakyat. So we did spend quite a lot of money, but not as to the amount like the US. So when the pandemic subsided, everyone got vaccinated, reopening, we saw US had a very strong economic recovery, right, back in 2021. And inflation started to actually speed up and go higher and higher. But at that time, central banks thought, this is just a temporary thing. It's not going to sustain. But by the time they realized that this inflation is not going away, from March 2022, that's when they decided, hey guys, we need to hike interest rates and we need to do it quick. Why? Because the Federal Reserve is worried that inflation become unanchored or runaway inflation. Why is that so dangerous? If you think about it, if you think that prices will continue to rise, right? Let's say you want to buy a bag and you think that, oh no, price is going to go up 20% next year. What are you going to do now? You will buy now. If everybody thinks that way, what happens? The price will go up because you fulfill it yourself, right? So this is what we call inflation expectation, something that central banks are very worried about. So they always talk about price stability. They want to keep price to increase by about 2 to 3%. That is the sweet spot, where there is still some price increase, but not inflation that is run away. And that's why they have to hike interest rates aggressively. At the peak, the US inflation hit about 9%. And in UK, it's even worse, more than 10%, and it's still staying around there in the UK. So we are seeing a landscape where there is a lot of uneven recovery and uneven monetary policy around the world. And that's where we think is interesting. And we are seeing opportunities and also risk in various segments of the bond market. So now the Fed has hiked 5%. What's next? So in June, the Federal Reserve finally said, okay, let's take a pause. Let's take a pause and re-look at the data and see whether what we have done over the last 15 months have been working. And now they are able to take a little bit more time. Rather than the last 1 year, what they've been doing is every meeting, hike 50 basis points, hike 75 basis points. So that's why last year it was a very tough market. But this year, we are still not 100% out of the woods because we think the Federal Reserve is likely to still need to hike about 1 to 2 times in the third quarter before they can be more comfortable and say, I think we got inflation under control, right? So I think this is the theme that I want to focus on, that we are a lot nearer to the end of the rate hikes as compared to the start of 2022. And for our bond investors and the long-term investors, I think it's good news because we are getting paid for the yields and able to ride on the higher interest rates at this time. So like I mentioned, the Fed is having a dilemma. So inflation is still staying higher than what they like to see, more than the 2%. Although I must say that it has come down from the peak, right, from 9%, and now it's about 4%. So it is seeing some improvement, but what they also want to see, very weird, is that they want to see that the labor market, the unemployment rate, they want to see it going higher. Why? Because now the employment market in the US is very hot, right? Even though last night we have weaker numbers in terms of the non-farm payroll, but overall, US labor is still able to demand high wages growth, over 4%. And, that's why the Fed said, I think we need to slow down the labor market to basically control this inflation. Because this inflation came from, like I mentioned just now, the strong demand due to all the stimulus and a strong labor market. So people are feeling rich and they're still spending money. So they have to engineer a slowdown. What is the potential risk here? The potential risk here is the Fed become overly too too tough, right? If they hike too much, then it could cause a major recession down the road, right? Because there is a lag impact between when you hike interest rates and when consumer will feel the impact. So if you were to listen to any market outlook early this year, I think most market commentators would say that, oh, this year we think that the US will go into a recession, or China reopening is going to be the story to go, and we're going to see that bond yields have peaked. And in the first quarter, it did seem that way, right? China reopening was seeing some strong data. We saw that bond had a very, very good rally in the first quarter. But then in March, that all came crumbling down again, right? We saw that the high interest rates in the US and around the world are causing some stress in the systems. From US regional bank, we had seen 2 banks that actually went under. And what we saw in Europe, even Credit Suisse. And there's also concern about the US mortgage, the commercial real estate sector, because post-COVID, offices in New York City and other major cities are seeing high record of unoccupied space, right, up to 20%. So there are some signs that the high interest rate environment is showing some impact. But what is kind of market was surprised is how strong the consumers are. Consumer spending continue to be strong because during the pandemic, they have been given a lot of money by the government. And also in the US, 90% of their mortgage are fixed rate. So people who have bought their houses before the pandemic or during the pandemic have locked in very low interest rates. And even with the Federal Reserve high interest rate, it's not going to impact them. Unlike in Malaysia, right, you and me, when we receive our bank statement, and we're like, oh, our mortgage payment keep going up. And that is the situation in most part, like in Australia or Canada, UK, is similar to our mortgage, which is floating. But in the US, because it's fixed rate, consumers are seeing a delayed impact on these rate hikes. But we do believe in the second half of this year, there will be a slowdown in the US consumers. Why? Because things are getting more expensive. Number 2, a lot of this stimulus will be taken away. For example, the student loan moratorium that was given to US consumers will be taken back as well. So they will feel a little bit tighter in their wallets. Yeah, so we think that second half, we see a slowdown in the US economy, which will then likely to see the Fed stop hiking rates in third quarter. So just now I mentioned that we are seeing a global slowdown. And within the different segment, I would say that Asia is seeing a bright spot in the case that our growth is still stronger compared to developed markets. And our inflation in Asia is also more manageable. It's lower compared to developed markets. So in terms of both equity and bonds, I think we do see some opportunities in this space. I'm not sure if you can see here, but let me just go on to the next slide. Here I have a table to look at emerging markets, right? So when we say emerging markets, we have 3 different categories. We have the Asia bloc, we got the Latin America bloc, and you got the Eastern European bloc, right? So emerging market bonds last year have also seen corrections across, but I think for Asian bonds, we have been the star outperformer. It wasn't great, but we outperformed the other parts of the world. And if you look at why, look at the CPI inflation numbers back in 2022, it is a lot lower compared to other parts of either the developed markets or the other parts of emerging markets, where our inflation, yes, it went up, but it's still very much controllable. And that means that our central banks in Asia do not need to hike as much and as fast compared to the other parts of the world. So our bond market also did not suffer as much losses. Yeah. And secondly, we did see a relatively good GDP growth in the second column, where after the pandemic, the reopening in Asia have also panned out relatively well. The only exception I would say is China, because for most of 2022, China was in lockdown, right? They only started reopening in end of 2022, but as we all know, the reopening was kind of disappointing. And so if you look at the nominal policy rate, that is the central bank interest rate levels. And you can see that for most of the Asian countries, most central banks have high interest rates, except China and Japan are the outliers, where Japan is still in that zero interest rate category, one of the very odd one in the developed markets. Whereas for China, they are actually cutting interest rates, right? The only major economy that are cutting interest rates. But the rest of the central banks have increased interest rates. But like I mentioned, it's very mild. Malaysia, we know that we have high interest rate from 1.75 to 3%. That's a total of 1.25%. Compared to the US, is 5%. Yeah? So that means that our bond market did not see as sharp a correction. And lastly, on the most right of your, the column, is what we call real yield or real interest rates. And what that means is like if you buy a 10-year government bond in those markets, when you buy a bond, right, what you want to earn is you must make sure that your bond returns is higher than inflation, right? You want to beat the inflation rate. So the higher the real yield means that the market is more attractive from that perspective. Yeah, so you can see that for Asia, most of the bond market is in positive real yield, which means that it's pretty attractive now. But it's not all the same across the emerging market world. One case I want to point out is on the last one, Turkey, right? That is one market that we will definitely avoid because Turkey had a really runaway inflation. Like I mentioned, inflation expectation is not anchored. Inflation in Turkey in last year is 72%. And as of now, it's about 40%. That's not somewhere you want to live in, right? And what is worse was the central bank did not hike interest rate. They were cutting interest rates. So there was a policy mistake. Because of politics, they needed to show growth. They just say, oh, forget about inflation. And that's why inflation got out of control. So recently, the Prime Minister said, oh, change the governor, change the economic minister, and now they are aggressively hiking interest rate to try to control the inflation. But I think the damage is done, right? So you can see the Turkish lira has really collapsed, yeah? So from here, what I want to highlight is within the emerging market, the landscape in Asia is a lot more stable. Bond market in Asia is more resilient, and we think it will continue to give you some decent returns in the next few years. Another part is Latin America. It's a segment that we like as well, right? So if you can have access to global bond funds that have exposure to some of these Latin American countries, but again, within that space, we only like Brazil and Mexico, where they have very high interest rates there. Now, let's move to China quickly. So China, I'm sure a lot of speakers will be speaking about, so I won't touch too much. From a bond perspective, China is one of the very few countries that are going to be looking at cutting interest rates. They have just cut interest rate in June. So that shows you that the government is concerned about the recovery is much weaker than they expected. Yeah, so the recent data coming out from China, whether it's from manufacturing, PMI numbers fell to new lows after reopening. Construction and service PMI also fell. And the property sector is still not showing much sign of recovery. It did well in the first quarter, but then subsequently, property sales came down again. So I think in China, there is an issue with the confidence as well, in terms of consumer confidence in the growth, about the property sector, and I think investors are also concerned about the last 2 years, there has been a lot of regulatory risk, right? You can see that the tech sector, there's a lot of pressure on tech sector and the property sector. And China also has a very huge bond market. They have the second largest bond market in the world. And what happened is half of the domestic bond market are actually issued by the local governments, right? The local government actually borrowed a lot of money to grow in their different provinces. But a lot of these are not doing well, their economic growth. So there's concern whether they can repay these loans or the bonds that they have taken out. So I think the government will have to do something, right? So in the last few weeks, we have hearing a lot of murmurs, a lot of rumors that China is going to stimulate the economy. They are going to announce more policy support. That's why you see that there's excitement in the bond market and the equity market. But so far, what we are checking is that unlikely to see very large kind of stimulus, not the scale that they have done before. It's likely to be more targeted to different segments that they want to tackle, unlike last time where they just print money or stimulate through infrastructure spending. Even the interest rate cuts in China, 10 basis points, it is very small, right? So it's not going to be very exciting. Yeah, so for bond investors, I think that I am still a bit more underweight in China property because we think that it will take probably multi-years to recover, and a lot of the private sector developers may not be the same. They won't go back to their glorious days back in, before 2020. But where we like is some of the state-owned enterprise. These are government-owned companies, which remains to be very strong and able to tap the market. So again, within the different bond market, we like different segments and dislike some. So my second last slide on bond valuation. I think we have not seen bond yields at these levels for multi-decades. Especially if you look at US Treasuries, you can buy a 2-year Treasury bond for 5% today. Compared to 3 years ago, it's at 0%, right? This is a little bit outdated in April, but now bond yields have even gone up a little bit higher. And so you can see all this weird language at the bottom. US Treasuries here. So historical 10-year median is 1.5%. Now it's about 4%. Then we have investment grade corporates. Investment grade, like I mentioned, is high quality bonds. Today you can get about 5 to 6% yield. Whereas over the last 10 years, they were trading about 3%, right? And in emerging market, this is in Asia and other parts of emerging market, the average yield is about 8.5%. Compared to last time about 5. Of course, high yield bonds are also giving you pretty high returns, 8, 9, 10% and even higher. So basically bonds are actually looking very attractive. But are we at the peak? I think third quarter will be a time where we are likely to be at the peak. But if you are to wait until bond price, or like bond yields peak and to come in, it's very hard to time the market. So what I would advise is that you should have some bonds to provide that stability and income for your portfolio. And the best thing to do is to do averaging, right? To gradually invest into the market. So just to sum up, we think that inflation has definitely peaked in most parts of the world. And we think that inflation, this is the inflation indicator that the Fed likes to use. It has peaked sometime here and then it's coming down. It's a matter of how long it takes to go down to where they like to see, which is the 2%. So we think it will take probably until maybe end of this year or end of this year or first half of next year for this target to be reached. The second theme, the global economy is slowing down. That is generally good news for bond market because it means that the interest rate cycle is coming to an end, the rate hike cycle. So bond valuation is attractive. You can get very decent yield, 5%, to 6, 7, 8%, right? So most of the bond funds in the market now, if you look at global bond funds, it could give you 7, 8% yield. For Malaysian bond fund, it's lower because our central banks did not hike rates as much, right? So, but the yield is still about 4, 5%. Lastly, geopolitical risk is something that we all have to live with for the many, many years to come, right? This will provide some more volatility for investors. And, you know, I won't talk much about it. Maybe we can tackle that in our panel session later. But yeah, I'm running out of time. But I hope that you enjoy the session, and we will catch up again during the panel session. Thank you.